As fear takes hold of global markets and headlines turn bearish with the second quarter reports, most investors are heading for the exits. But smart money? It's quietly moving in, positioning itself for what could be one of the most significant wealth shifts in years. As panic spreads, three AI-focused stocks, including Celestica, are breaking out and redefining the rules. One leads in AI infrastructure, another in quantum, and a third is quietly dominating chips. Let's break down what's happening and why breakout investors are paying close attention. But first, we're celebrating 1,000 subscribers with a free guide on spotting breakout stocks. Grab it from the description, and don't forget to like, share, and subscribe. This isn't financial advice, just insight. Always do your research. All right, let's continue. Just a few days ago, we spotlighted Celestica Inc., ticker symbol CLS, as one of the three stealth breakout stocks quietly rewriting the growth playbook. At the time, it was trading around $156, already up 67% year-to-date. And we said this might only be the beginning. Fast forward to July 29th, the market just confirmed that thesis in bold. Celestica didn't just rise, it erupted. After posting its Q3 earnings, CLS surged plus 16.51% in a single session, closing at an all-time high of $202. That move brings its one-year return to an astonishing 304%. So what happened? And is the rally still alive? Let's break it down. First, the earnings that justified the hype. On July 28th, Celestica released its second quarter earnings, and they didn't just beat expectations, they crushed them. Revenue increased 21% year-over-year to $2.89 billion, surpassing estimates by more than $220 million. Non-GAAP earnings hit $1.39 per share, topping consensus by 15 cents, and GAAP earnings more than doubled, reaching $1.82 per share, thanks to significant operational leverage. The connectivity and cloud solutions segment was the driving force behind this growth, accounting for over 71% of total revenue and increasing by 28% year-over-year. That's right, demand from big tech for Celestica's next-generation networking equipment, including 400G and 800G switches, continues to grow. Their hardware platform solutions aren't just good, they're vital. Even free cash flow joined the party, rising to $119.9 million from $65.6 million in the previous year. With $313 million in cash available and upgraded guidance across all metrics, CLS now forecasts $11.55 billion in full-year revenue, $5.50 in adjusted EPS, and $400 million in free cash flow for fiscal year 2025. The numbers don't lie. Celestica isn't just riding the AI wave, it's building the infrastructure for it. We can confirm the breakout from Technical Picture. CLS just sent a loud message to the market. It blew through key resistance at $175, a ceiling it had been testing for weeks. The breakout came with significant volume, suggesting institutional support. And most notably, it set a new all-time high at $202. This isn't your average technical bounce. This is smart money positioning, chasing fundamentals and future cash flows. The uptrend? Accelerating. The RSI? Bullish. The momentum? Undeniable. Celestica isn't just climbing, it's being re-rated by the market in real time. A strategic pivot that's paying off. So why is CLS breaking out now? Because it's not the same company it was 5 years ago. Celestica has quietly evolved from a low-margin contract manufacturer into a high-margin design-centric infrastructure partner. The focus now? Hyperscaler racks, dense GPU servers, and 800G networking for AI data centers. Their hardware platform solutions, HPS business, is sticky by design, often single-sourced, meaning once Celestica wins a contract, it tends to hold it. That's pricing power, that's predictability, that's leverage, margins are expanding, design wins are compounding, and EPS is accelerating, all while the market is just beginning to catch up. This transformation is happening at the perfect moment, just as hyperscaler demand for AI-ready infrastructure is exploding. This is what strong execution looks like, and Wall Street is taking notice. Currently, Celestica has an average brokerage rating of 1.55, between a strong buy and buy. Out of 12 firms covering the stock, 10 rate it a buy or strong buy. That's over 83% bullish coverage. Celestica isn't just riding a macro wave, it's building the foundation for it. With AI infrastructure demand hitting escape velocity, hyperscale needs partners who can deliver, scale, and adapt. Celestica checks every box. The earnings beat was real, the technical breakout is confirmed, and the market's revaluation is already underway, but may still be in its early innings. For investors seeking high-quality AI infrastructure exposure without chasing hype, Celestica is worth a serious look. Moving to the following stock, a quiet contender in the AI infrastructure boom. Marvell Technology Inc., ticker symbol MRVL, a key player in data infrastructure semiconductors, is beginning to stir interest once again, not with flashy headlines, but through methodical, technical resilience. The company, known for its system-on-a-chip architectures that extend from data center cores to edge networks, saw its stock surge to a high of $126 earlier in 2025. However, that rally quickly faded. As the AI hype cycle cooled, MRVL experienced a sharp correction, losing over 60% of its value and dropping to just under $50 by April. That decline flushed out the fast money, but what followed is what savvy investors pay attention to. Since bottoming, Marvell has been quietly rebuilding. The chart now shows a different story. A series of higher lows and higher highs is forming, indicating a bullish pattern in its early stage. As of this week, the stock trades at $76.44, still 38% below its highs but significantly higher than the April low, and nearly 18.4% higher year over year. Technical aside, there's momentum building beneath the surface. Volume patterns are showing signs of institutional accumulation. Resistance is being tested near the $80 zone, and if broken, could unlock a potential breakout ahead of earnings, which are expected between August 27th and September 1st. What's fueling this quiet resurgence? Recently, MRVL rose 3.3% in a single session after announcing a strategic partnership with South Korean AI chipmaker Rebellions. The two companies plan to develop custom, high-efficiency AI systems for government-backed initiatives across Asia-Pacific and the Middle East. Using Marvell's advanced packaging and high-speed interconnect technology, the collaboration will produce tailored AI accelerators for large-scale national projects. This is a significant move. It positions Marvell to secure a share of a quickly growing market, government-driven AI infrastructure. It also highlights the company's goal to be more than just a component supplier. It aims to be a comprehensive AI solution partner. Meanwhile, analysts anticipate fireworks in the upcoming quarter. Consensus estimates project 67 cents in earnings per share, a significant 123% increase year over year, along with a 57.89% rise in revenue, reaching $2.01 billion. Despite the optimism, the stock is still 32% down year to date, making it one of the most beaten-down names in the AI semiconductor space. But that's where the opportunity lies. While other AI plays trade at sky-high valuations, MRVL could offer asymmetric upside, especially if earnings surprise to the upside or if it breaks out past $80 with conviction. Still, investors should remain selective. We are continually watching several lesser-known AI stocks that are trading at deeper discounts and benefiting from more substantial onshoring tailwinds. If you're searching for a high-conviction idea riding the AI boom and Trump-era tariff momentum, check out the following video. But before that, let's take a look at the third AI tech stock on our list. D-Wave Quantum, ticker QBTS. Is this a speculative moonshot or the future of computing? Wealth often finds its roots in volatility. And right now, in the eye of a tech revolution, D-Wave Quantum is quietly rewriting what could become the next chapter of exponential innovation. Over the past year, D-Wave has staged an almost mythical ascent, skyrocketing 1,684% from penny stock territory under $1 to its current level around $17.67, despite a modest pullback from its recent highs. This isn't your typical retail-driven frenzy. Instead, it reflects a seismic shift in how markets are beginning to price quantum-first infrastructure, especially when interlaced with AI and blockchain. Let's break it down. The chart doesn't lie. QBTS experienced two distinct surges, a bullish breakout in December 2024, followed by a strong continuation in June 2025, both supported by heavy volume and clear technical patterns. Right now, it's consolidating just below the $20 resistance, forming what could be a bullish base before Q2 earnings on August 7th. In short, the stage is set, and technical indicates this rally might not be over yet. At the core of D-Wave's rise is a transformative strategy. In Q1 2025, the company launched a quantum-powered blockchain architecture, a disruptive, energy-efficient alternative in a sector troubled by scalability and environmental issues. This isn't just innovation for innovation's sake. It's a strategic move aimed at expanding D-Wave's sales pipeline, encouraging adoption among AI-focused enterprises. By combining quantum computing with real-world applications in blockchain and artificial intelligence, D-Wave is establishing itself not just as a tech vendor, but as a platform enabler. That story is gaining momentum quickly. Now to the numbers. D-Wave is set to report Q2 2025 results on August 7th. Analysts expect $2.52 million in revenue, a 15.7% year-over-year increase. Losses are projected at 7 cents per share, unchanged from prior estimates, but narrower than the 10 cents per share loss in the year-ago quarter. While the stock's performance has outpaced fundamentals, there are key catalysts that could support this valuation and potentially push it higher. The highly anticipated Advantage 2 system was expected to achieve general availability, GA, by the end of Q2. This system offers significant upgrades, faster annealing, improved error mitigation, and longer coherence times, all essential for tackling more complex AI and optimization challenges. If GA was truly achieved on schedule, it might have expanded access through the Leap Cloud platform, boosting customer adoption. D-Wave's enterprise progress is also significant. Deployments at Ford Otosan and Japan Tobacco marked essential milestones. Management hinted earlier this year that more applications would be moving into production stages throughout 2025. Programs like Leap Launchpad, which performed strongly in Q1, could have driven new trial-to-paid conversions, further boosting top-line growth. With increased focus on AI and blockchain partnerships, D-Wave is steadily building demand and potentially recurring revenue. Still, the company is in the early stages. Earnings volatility is likely to continue, and its high valuation may worry risk-averse investors. So, should you load up before earnings? That depends on your risk appetite. D-Wave could very well surprise the market if its Advantage 2 GA, Leap platform uptake, or AI initiatives materially shift revenue guidance. But if results fall short, the stock may correct just as quickly as it climbed. As the market braces for August 7th, investors must weigh the question, is this merely a quantum bubble, or the beginning of a multi-decade computing revolution? In the comments, tell me, would you have invested $1,000 into CLS stock a few weeks ago when it was trading for less than $58 or any of the two other AI tech stocks? Why or why not? However, please note that this video doesn't constitute financial advice and is intended for educational and informational purposes only. Investing in stocks is risky, as past performance doesn't guarantee future results. We're expecting great potential in AI stocks, but we don't know which ones exactly, as we've highlighted some with stronger long-term fundamentals. Watch the following video.